Hello everyone, welcome to our monthly podcast series. I'm Nova Lui, RHB Bank's Head of Investors Advisory. In today's podcast, we have Tan Jee Toon, CIO of Asia Pacific Equities and Head of Asset Management Singapore, to share with us on pressing issues from China, including continuous government crackdown on some major technology companies, also his view on PBOC monetary policy. Is this a good entry point for investing into Asian equity? Let's hear from him shortly. While we also have Encik Muhammad Fauzi bin Muhammad Tahir, CIO Equity of RHB Asset Management, will share with us on his view on Malaysia equity, riding on the latest news of Malaysia's transition into endemic phase of COVID-19. Hi Jee Toon, thank you in advance for joining our monthly podcast series. Our client's main concern, China. In February 2022, Chinese authorities announced that food delivery platforms should further reduce the service fee charge. This has caused some China technology company share price to drop materially. In fact, since last year, we have witnessed various changes in the China policy, especially relating to the China technology company. Any further changes in policy amid uncertainty is not welcome by the equity market. How should investors position their investment portfolio to weather these changes? Is there any turnaround point investors should watch out for?
Hello everyone, very happy to be here today for this podcast. With regards to the question on the possible reduction in service fees charged by food delivery platforms, I wanted to provide some clarifications on the overreaction by the markets on this recent news. On 18 February 2022, China's NDRC proposed more than 40 policies to help businesses in pandemic-stricken areas, which included the retail, catering, travel, and transportation industries. In the section on the catering industry, the statement from NDRC mentioned that the regulator will encourage online food delivery platforms to offer temporary preferential rates to restaurants in medium and high-risk COVID areas. We think there's an overreaction by the markets as the impact on the online delivery platforms will not be significant as the geographical areas of medium and high-risk COVID areas are limited. And these preferential rates are temporary in nature to help the restaurants tide through these difficult times. More importantly, these policies were not targeted at online companies and were in fact general guidelines for a variety of online and offline sectors. Our investment view remains that we are at the tail end of the regulatory crackdowns on the Chinese internet sector and are past the worst of the regulatory tightening. Valuations of some of the key Chinese internet stocks that we liked are at deeply distressed levels and have more than priced in the worst case scenarios. We believe that there are ample attractive investment opportunities for savvy investors who are able to look beyond the current near-term turmoil.
Hi Fauzi. Talking about increased cost of living, Malaysia equity market somehow benefited from rising commodity price, especially crude palm oil and crude oil. Is this trend expected to last for the entire year? Would Malaysia continue to benefit from the higher commodity prices?
In our view, the current geopolitical instability could result in crude oil prices shooting up to $120 per barrel in the short term. In fact, the Brent crude oil price is at $126 per barrel as at 8 March. This has surpassed our prediction at $120 per barrel. However, we expect the oil price to stabilize to $90 to $100 per barrel, given that US and other oil producers could ramp up their production in the second half of 2022. It is also very likely for the producers and other International Energy Agency members to implement their emergency stockpile sharing to the European market, which is the most affected region. The emergency stockpile sharing was previously used during the Hurricane Katrina in the middle 2000s. As long as the conflict doesn't drag on, we expect demand growth to remain intact, with a target of 100.8 million barrels per day for the year 2022, with a growth of 2% on an annual basis, which assumes there will be a stronger fuel demand recovery by both OECD and non-OECD countries. In addition, the COVID impact is expected to be mild and temporary. We also believe for the first time palm oil has become the most expensive among the four major edible oils due to buyers rushing to secure replacement for sunflower oil shipment from the top exporting Black Sea region that were disrupted by Russia's invasion of Ukraine. The Black Sea accounts for 60% of world sunflower oil output and 76% of exports. Most of the incremental demand for palm oil is fulfilled by Malaysia, as Indonesia has put restrictions on the exports. Although refiners have the option of buying soy oil as well, prompt soy oil shipments are limited in near term as they take much longer to land in Asia compared to palm oil. We also seeing the steepest future CPO curve since the pandemic. The chart sparks question on how real businesses are going to be conducted, especially price-sensitive demand countries like India. Although near-term soy oil supply is limited to logistic time lag, as well as South America suffering from bad weather, history suggests palm premium could fade in medium term as buyers shift to soy oil over time.
Back to you, Jee Toon. Policy support to boost economic growth. In January 2022, China's central bank cut both 1 year and 5 years loan prime rate by 10 and 5 basis points respectively. However, PBOC has nevertheless reiterated over and over again that the committee will not resort to a flood-like stimulus measure. Is the central bank making effort to talk down the financial market? And most importantly, does the prospect of easing even have any catalyst for the Chinese equity market given the scale and the limited sector coverage of the policy support?
The Chinese government has indeed been easing on multiple fronts in order to support the economy. There had been 2 RRR or reserve ratio requirement cuts in 2021 and 1 benchmark rate cut in 2022. These easing measures in China are a stark contrast to the tightening and rate hikes expectations in other parts of the world. We think that this is a very important difference in an investment environment where investors are very wary about tightening liquidity. In fact, the recently concluded National Party Congress or Lianghui in early March, China set an economic growth rate of 5.5%, which was higher than the 5% that the market was anticipating. In view of the volatility in the external environment, we expect China to look inwards to support growth in 2022. We expect increased emphasis on domestic consumption and internal upgrading of industry and infrastructure, financed through coordinated fiscal stimulus and monetary policies.
Hi Fauzi, investor in the span of the last 1 month, given the recent uptick in KLCI, in your opinion, are we expecting profit-taking activities soon for our local equity market, similar like what we have seen in last year's August and October?
Malaysia ringgit may be the largest beneficiary in emerging Asia should energy prices rise further. This, in our view, has attracted foreign funds to buy Malaysian equities aggressively in February 2022. We have seen the foreign funds slowly come back to buy Malaysian equities from August 2021. The foreign funds will only turn net seller in December 2021 when the Omicron variant emerged. However, foreign funds turned net buyer in January 2022 and aggressively buying Malaysian equities in February 2022 despite the Russia-Ukraine war. We believe foreign funds are seeing value emerging in Malaysian equities after the reopening of the economy since third quarter of last year, and the sharp rise in oil price and CPO price will provide more support to the economy.
Jee Toon, back to China again. COVID-19 measures around the world, including Asian countries, has eased significantly. But China continues to maintain its zero COVID-19 policy. Will this suppress the economic recovery and prolong the spillover of the supply side issue to the global market?
Indeed, China is one of the few countries in the world that is still pursuing a zero COVID policy. I would also like to point out that in 2021, despite a highly restrictive zero COVID policy, China had a record-breaking year in terms of export and FDI and an impressive 8.1% GDP growth rate. These data indicate that such a restrictive approach did not have a big negative impact on China. However, we are starting to see initial signs that China is modifying its COVID policy from an absolute zero COVID policy to a dynamic zero COVID policy over the last few months. This means that China has shifted from a zero tolerance approach to a more precise and targeted approach to ensure the least possible disruption to economic and social activity. As such, we believe that a change from the zero COVID policy in 2022 will help to boost the Chinese economy.
Okay, while China is still on its zero COVID-19 policy, Malaysia is moving towards reopening of borders and transition into local endemic. At the time when Omicron variant wave hit Malaysia and pushed numbers to record high. Fauzi, in your opinion, will this derail economic recovery efforts?
Latest evidence shows daily COVID-19 cases count have been slowing down of late from its peak in January for developed countries, which was previously surged due to the spread of the Omicron variant. The death count is also lower than the previous Delta variant. The developed countries have started to reduce most of the restrictions implemented earlier as falling infection rates suggest the Omicron wave have peaked. We believe the risk of a renewed lockdown for Malaysia has decreased significantly this time around due to the high vaccination rates of more than 80% of the population. Meanwhile, the government is also preparing to open its borders to international tourists, which would help revive the tourism sector. In short, the risk of Omicron derailing Malaysia's economic recovery has been greatly reduced compared to a few months ago.
Jee Toon, that comes to my last question for today. So, in the middle of every difficulty lies opportunities. Is the valuation now, together with volatile market condition, viable for an entry point to the Asia equity market?
Warren Buffett once said, "Be fearful when others are greedy, and be greedy when others are fearful." The current valuation of Asian equity markets compare very favorably against the US and the world stock markets. On both price to book and price to earnings valuation metrics, Asia is much cheaper than both US and world stock markets. In addition, the current positioning in Asia is very light for global funds as they are underweight Asia and China in particular. We believe that with the current valuation differential for Asia versus the world equity markets and the fact that China is easing when the rest of the world is tightening, certainly make investment in Asia more attractive. Current market volatility certainly provides interesting entry points for the patient investors who are able to look through the near-term challenges.
That comes to the end of our monthly podcast series today. Thank you to Jee Toon and Encik Muhammad Fauzi for their insightful sharing on the prospect for investing into emerging market and also insight on the Malaysia equity market. Please scan the QR code below if you want to know more about the global market outlook view from Dr. Jia and also insight on rates and fixed income together with Michael Chang. If you want to know more about our latest investment insight and also potential investment solution that may potentially suit your risk profile, please keep in touch with our relationship manager. Thank you very much to Mr. Tan Jee Toon and Encik Muhammad Fauzi for their insightful sharing for today's podcast. Please scan the QR code below for the recent podcast on global market outlook and prospect for fixed income investment. Visit our RHB's merged website to view more financial content to help you make informed investment decisions.